Right now, something is happening in Bitcoin's derivatives markets that has only occurred once in the last 18 months. And the last time it happened, August 2024, Bitcoin was sitting at $55,000. Everyone was convinced it was heading lower, and then it went on an 83% rally over the next 4 months, all the way to $106,000. That exact same signal just fired again, today, right now. I'm not talking about a gut feeling. I'm not talking about hopium. I'm talking about hard data from Santiment's aggregated funding rate charts across every major exchange, Binance, Bybit, OKX, all of them simultaneously flashing the most extreme bearish positioning since that August 2024 bottom. The bears are in full control of the narrative right now, and that's precisely why you need to pay attention to this. In this video, I'm going to break down exactly what this signal is, why it's historically been one of the most reliable contrarian indicators in crypto, what needs to happen to trigger the squeeze, and the exact price levels that could detonate it. If you don't understand what a short squeeze is and how it could affect your portfolio in the next few weeks, hit subscribe and stay with me for the next 10 minutes. This is important. Let's start with the raw data, because the numbers here are genuinely shocking. Bitcoin funding rates across every major centralized exchange have collapsed to their most deeply negative levels since August 2024. According to Santiment's funding rates aggregated by exchange metric, which blends data from multiple major platforms to give a complete picture, the red bars on the chart are now dominating at levels we simply haven't seen for 18 months. Bitcoin is currently trading at around $68,740. But here's the wild part. The short-term cost basis for traders who are short right now sits at approximately $90,900. That means traders are aggressively betting that Bitcoin goes down from $68,000 while they open those shorts much higher. They're sitting on underwater positions and doubling down, and they are paying for the privilege of doing so, because that's what negative funding rates mean. Let me explain funding rates in plain English, because this is the engine behind the whole story. In crypto perpetual futures markets, the most popular way institutional and retail traders speculate, there's a mechanism that keeps the futures price aligned with the actual spot price. That mechanism is the funding rate. Here's how it works. Every 8 hours, traders on one side of the trade pay traders on the other side. When funding rates are positive, long traders pay short traders. That means more people are betting on the upside. When funding rates are negative, short traders pay long traders. That means more people are betting on the downside. Right now, short sellers are paying long holders to hold their positions, and they're paying at the highest rate since August 2024. What does that tell you? It tells you the market is overwhelmingly, almost unanimously positioned for Bitcoin to go lower. And here's the thing about unanimous positioning in financial markets. It almost never plays out the way the crowd expects. Let me walk you through exactly what happened the last time we saw this signal, because the parallel is remarkable. August 1st through 6th, 2024, Bitcoin had just fallen $12,000 in a matter of days, a brutal, fast crash. Fear was everywhere. Derivatives traders piled into shorts. Funding rates plunged deep into negative territory. The narrative was, Bitcoin is heading to $40,000. Maybe lower. Sound familiar? Instead of continuing lower, Bitcoin reversed. Slowly at first, then violently. Short positions began getting liquidated as the price ticked up. Those liquidations forced short sellers to buy back their positions, which pushed the price higher, which triggered more liquidations, which pushed the price higher again. That feedback loop, that's the short squeeze. Over the following 4 months, Bitcoin climbed from a bottom of $55,000 all the way to $106,000, an 83% rally, driven not by new fundamental news, not by ETF approval, not by any single catalyst, but by the mechanical unwinding of overcrowded short positions. The same structure is forming right now. And here's the thing about unanimous positioning in financial markets. It almost never plays out the way the crowd expects. Now, the funding rate signal alone would be compelling, but there's a second data point stacking on top of it that makes this even more interesting. The net unrealized profit and loss indicator, NUPL, has dropped back into what analysts call the hope and fear zone, sitting at approximately 0.18. Here's what that means in plain terms. The average Bitcoin holder is barely in profit. Thin margins, no cushion. When NUPL is in this zone, the market becomes hyper-reactive. Small price moves in either direction trigger outsized responses because holders don't have deep, unrealized gains to absorb volatility. They're on edge. They react fast, and that hyper-reactivity cuts both ways. On the way down, thin profit margins mean holders panic sell quickly. That's what we saw on February 5th when Bitcoin dropped 13% in a single session. But on the way up, thin margins mean short sellers panic cover quickly because there's no buffer. A small move upward starts liquidating the most vulnerable shorts, which forces buying, which triggers more liquidations. The NUPL signal is essentially confirming that the market is sitting on a hair trigger, and the funding rate signal is confirming which way that trigger is pointed. Over the following 4 months, Bitcoin climbed from a bottom of $55,000 all the way to $106,000, an 83% rally, driven not by new fundamental news, not by ETF approval, not by any single catalyst, but by the mechanical unwinding of overcrowded short positions. The same structure is forming right now. And here's the thing about unanimous positioning in financial markets. It almost never plays out the way the crowd expects. Let's get specific, because knowing the signal exists is only half the equation. You need to know what price levels actually detonate it. Here's the technical picture right now. Bitcoin has already broken out of the steep descending channel it was trapped in for 4 months. It's currently grinding just below the $70,000 to $71,000 supply zone, a critical area that aligns with prior resistance. For the short squeeze to trigger in a meaningful way, Bitcoin needs to break above $70,610 on a daily close basis. That's the key level where analysts believe the squeeze pressure really starts building. If that level breaks and holds, the first target is $76,000. That's where a wave of short liquidations would force rapid buying. Above $76,000, resistance thins dramatically toward $80,000, with $90,000 and $98,000 acting as higher air pockets, areas with very little sell pressure, where momentum could accelerate sharply if it builds. On the downside, $64,000 is the line that holds the entire structure together. If that cracks, $60,000 becomes the final major demand zone before the chart becomes unstable. So the risk reward here is clearly defined. Below $64,000, the thesis breaks. Above $70,610, the thesis accelerates. Now, August 2024 isn't the only precedent worth studying. There's a more recent one from October 2025 that's even more directly relevant. October 10th, 2025. Binance experienced a massive liquidation event. Billions of dollars in long positions were wiped out in a single session. Bitcoin crashed hard. In the aftermath, what did traders do? They rotated en masse into shorts, convinced that downside would continue. Funding rates plunged, and then a recovery, forced short covering, a mechanical bounce. Santiment explicitly pointed to this event as a modern confirmation of the August 2024 playbook. The same pattern, mass liquidations create one-sided positioning. One-sided positioning creates the conditions for a reversal. Reversal triggers squeeze. We are now at the third instance of this pattern forming within 18 months. The first two resolved to the upside. The data says we may be setting up for a third. Now, I want to give the other side of this argument because it's important and because the bears aren't wrong about everything. The bearish narrative right now is genuinely well supported on the surface. Standard Chartered just slashed its Bitcoin price target from $150,000 all the way down to $100,000 for end 2026 and warned Bitcoin could slide to $50,000 in the near term first. ETF outflows have been brutal. Nearly $8 billion withdrawn from US Bitcoin ETFs since the highs. Bitcoin is down 23% year to date. Macro conditions are murky. Rate cuts aren't expected until at least June. Correlation with equities is rising. All of that is real. All of that creates genuine downside risk. But here's the problem with the bearish case right now. Everyone already knows it. It's priced in. It's the consensus. When bearish information is consensus, it's already reflected in positioning. And the positioning data shows us exactly that. Maximum shorts, maximum negative sentiment, maximum bearish conviction. Markets don't crash when everyone expects them to crash. They crash when the crowd gets caught leaning the wrong way. Right now, the crowd is leaning short, aggressively short. So what's the catalyst? What actually triggers this thing? Sentiment is clear. Heavy short positioning doesn't guarantee an immediate reversal. All it does is create the conditions, a fragile, loaded market where a small push upward can cascade into something much bigger. There are several potential catalysts that could provide that push. First, macro surprise. If CPI data comes in cooler than expected, or if Fed language shifts even slightly more dovish, risk assets get a bid. Bitcoin gets a bid. Shorts start covering. Second, institutional inflows returning. Bitcoin ETF flows have been negative for weeks. If even one or two large institutional buyers step back in, BlackRock, Fidelity, that creates visible buying pressure that forces short covering. Third, the February 20th mining difficulty adjustment. If the hash rate has recovered enough to trigger an upward difficulty adjustment, it signals network strength. Sentiment shifts, price moves up, shorts cover. Fourth, a simple price squeeze. Sometimes there's no catalyst at all. The market just finds a level, turns, and the mechanics do the rest. Let me bring this home. Sentiment's aggregated funding rate data is showing the most extreme short positioning across crypto exchanges since August 2024. The last time this happened, Bitcoin was at $55,000 and went on to rally 83% over 4 months to $106,000. NUPL is sitting in the hope and fear zone at 0.18, confirming thin profit margins and a hyper-reactive hair trigger market. The technical structure shows Bitcoin grinding below key resistance at $70,610, with the chart already broken out of the descending channel. A daily close above that level could trigger a cascade of short liquidations towards $76,000 and beyond. The bearish narrative, standard chartered cuts, ETF outflows, macro uncertainty is real but already priced into positioning. That makes it less dangerous, not more. This does not mean Bitcoin can't go lower. It absolutely can. $64,000 must hold or the thesis breaks, and the macro environment remains genuinely challenging. But if you're only watching the price and reading the headlines, you're missing the actual signal that matters, and that signal is screaming that the bears may have just made a very crowded, very dangerous bet. Here's your action plan. Watch $70,610 on a daily close. That's the trigger level. If it holds above $67,000 on any pullback, the setup remains intact. If $64,000 breaks, step aside. The squeeze thesis fails. Don't size in with leverage. Let the setup confirm first. The macro catalyst to watch is the February 20th mining adjustment and any CPI data between now and March. The market is loaded. The trigger is cocked. Watch the levels. Drop a comment below. Do you think the short squeeze fires? And at what price do you think it breaks? I'll be watching the data and updating as it develops. Subscribe so you don't miss it.